Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show this week. As in every week, we bring to you your interest in what we have to say each and every week about mortgages. That's kind of what I'm trying to say. I had a little dental work today, so if I am slurring, I am not drinking on air. I am not doing that. But the dental work was tough because anybody that's had a root canal will know you get your whole mouth numbed, and that's kind of where we are right now. But again, thanks for tuning in. The Mortgage Show, what we do, how we do it each and every week. We bring experts onto the show. Mostly it's people in the business, people who have been in the business for a long time that'll either present you a program, a rate, a different perspective on your situation to try to help you figure out whether you want to use a traditional product or maybe more of a non-traditional product, what they call non-QM now. They used to back in the day call it subprime. They back in the day called it all kinds of things, Alt-A. There are a number of different names that were used. But generally speaking, in today's world, what we try to do is match you up with the best program out there. Now, rates being what they are, even in the non-QM world, the non-traditional world, the non-Fannie, the non-Freddie world, we get rates that are spectacular. And why do I say that? When we started, I guess it was back in '02, right? That's when the company started. Rates for these types of loans were 3, 4, and 5 points above what the rates were for, a regular loan. Like a 30-year fixed rate loan back in the day, I guess it was, let's say it was 8%. Now that's true, it was 8%. It has been higher. As I've said many times, my first loan was 8.75%. Can you imagine today's market? What would happen if that was the rate? Right, there wouldn't be a real estate market. A mortgage market, but there would be plenty of real estate on the market, and that's a trade-off we get with low rates, right? Everybody wants to go out and buy a house because it's so cheap to do that. But today, the rates on subprime homes, i.e. subprime mortgages, or what they call non-QM now, those rates are only about 1/2 to 3/4 to a point higher. Not 5 points higher, but a point higher. So if you have a 30-year fixed rate loan at 3%, you could probably get a non-QM loan in many cases for 4%, maybe 4.5%. That is great because it allows you to be in a competitive way with people who are getting standard 30-year loans. Now the 30-year loan, what is that? It's somebody who has a W-2, somebody who's been working a long time, somebody who has a 700 plus FICO score. Those are the people who would get those types of loans because they would have probably a 20% down, 10 to 20% down. Now there are Fannie Mae and Freddie Mac loans right now that you can get for 10% down, and you can get for a lower FICO score. You're going to pay a higher rate on your loan, but you can get those types of loans. But the ideal customer for Fannie Mae and Freddie Mac, the ones that we look, at the lowest rates, those rates you see quoted each and every day, whether it's on the radio, on television, or whether you talk to your particular mortgage broker or banker, or you go to the big box bank down at the corner, they're going to quote you the rate that is for this great borrower. So like I said, 740 FICO, W-2 earner, 20% down on a purchase, and somebody who is obviously just looking to do a rate and term refi. They're going to get the best rates. Those other people are not. But when you talk about bank statement loans and you're talking about ITIN loans, those are for foreign nationals, or you're talking about a 24 or a 18 or a 12-month bank statement programs, or you're talking about a business bank loan bank program, mortgage program, those particular rates are still great because everything considered into you as the borrower is going to be your credit score, your ability to repay. That's about the most important thing out there, that and your credit score, of course. The ability to repay. You're in the marketplace. How are you going to pay back a loan, right? Obviously, the rate's important to you because you want to pay as little as possible. But to the bank, the most important thing is whatever rate we give you, can you pay us back? Now, in California, in many states across the country, now this show is in several states, as everyone knows, down in New Mexico, Albuquerque, for instance, thank you, and hi to everybody down there, as well as up in Las Vegas, Nevada, in Central California, as well as in the Inland Empire in Southern California, and hi to all those great people who listen to the show every week. Matter of fact, I got a call today. Guy heard Kim Tran on the show last week from AM West, and wanted to have his number. He's heard a program that he wanted to talk to Kim about, so I was very happy to pass that on to him. If you have a question, call me. Go to the website. Malibu Funding has a website, and is our Mortgage Voice website up yet?
We just need a couple of small things.
Okay, very good. So that will be up. The Jeff Barton, the Mortgage Voice. It's, what is it called? TheMortgageVoice.com?
It is themortgagevoice.com.
Okay, there is currently a website up, but we are changing it and we're adding some things and making it much more user-friendly for people who need the information on each and every show. Like this guy that called, he was saying, hey, where is this guy that you had on your show last week, Kim Tran from AM West? So I texted him the number, but in the future you'll be able to search on our site, find the segments more easily, and certainly themortgagevoice.com, that's a great place to get information currently as well as archived shows. We're also on YouTube if everyone wants to see that. We're on a number of different podcasts, as I said, the radio stations, rates and programs. That's what we try to push on the show, mainly because that's what most people are interested in. How can I get what I want, and how can I pay the least amount possible? These are the questions and answers that everybody has on every loan, and everybody wants to slide one by you. I had a processor. Now in our business, we have originators, we have processors, we have funders, we have underwriters. There are a number of job-specific categories. One of them is appraisal. I had one of my processors call me today and said, listen, I have a company that we're going to use, and they don't need AMC appraisals. I said, what do you mean you don't need AMC appraisals? And those are, back in 07, when the appraisers were accused of juicing the value of a property in order to get the appraisal. Back when buyers, sellers, agents, mortgage loan officers had direct access to the appraiser, they could apply a great deal of pressure in order to get the value that the property needs in order to do the loan. Well, you can't do that now. It's illegal. It's arm's length always. So I had a processor tell me that the borrower said that he had an appraisal done by somebody he knew, and can we use that appraisal? Apparently the guy had 4 appraisals done, and the person he knew just happened to come in with the right value for his property. So I immediately said, well, that's it. That's illegal. You got to be hands off and arm's length. So immediately nixed that particular idea. Anybody who's talking about knowing the appraiser or having the ability to talk to them or paying them directly rather than through an AMC, and AMC is the company that stands between the payment and the actual job being done, and you can't really know these people. It's just, I don't know if anyone remembers 2008. There's been a lot going on since then, but believe me, we don't want to go back to any time soon where there's this problem whereby the appraiser and the borrower are talking, or the loan officer and the appraiser are talking. Reason being is that at the bedrock of all these loans is the value, the true value of that particular property. So in this particular case, I don't know what we're going to do. We got to go back and get an AMC approved appraiser and an AMC approved appraisal in order to do this particular loan. No, we can't do it at all. And I have to go to my processor, I have to tell the borrower. Yeah, so if you're out there thinking about that as a solution for yourself, it's not. There are many programs out there that you do qualify for. If this guy can repay his loan, if he's got a decent FICO score, it's just a matter of adjusting the borrowing price to the actual value of the property, not making the value of the property match what you want to borrow. You understand? Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and we'll be right back.
The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. Thanks very much. Again, the loyalty for the audience is great. Got some great phone calls last week on the show we did. We bring professionals on. We try to give a perspective that isn't just a rah-rah show about me or my company that I work for or sponsors this show, Malibu Funding. We really want to help you out there because, it's a tough market if you want to buy something, right? Everybody knows that. What kind of products are we going to use? How are we going to get the best rate? How are we going to compete? All of this stuff it's hard on you as the buyer, and I know that. And if you're a cash-out refi guy or you're a gal who wants to, lower your rate in order to lower your payment, that's the kind of stuff that we try to do and that we pride ourselves in. We've been doing it for 7 years, so we know that what we're trying to do really works. And again, appreciate you listening to the show. Bringing experts to the show, that's what we do. Today is no exception. We bring to the show, and again, sorry if I'm slurring. I had some dental work done today, and I don't know, at least my teeth aren't whistling. Ryan Baggin from 11 Mortgage. Ryan, how are you?
I'm doing fantastic, Jeff. Thanks so much for the opportunity.
Thanks very much for coming on the show. Okay, 11 Mortgage. Give us a brief overview of the company. What is the type of borrower that you're looking to help?
Well, we know we're a strictly agency company, conventional FHA, VA. We also offer USDA. We're pretty much a vanilla shop. We offer FICO scores down to 620. We're huge when it comes to our veterans. We take pride in supporting the people that, fought for our country and gave us the ability to have such a beautiful, life and all the freedom that we have. So pretty much we're vanilla. We're pretty vanilla if you're looking at us like ice cream.
Okay, interesting you say that. I know you compete out there. There's a lot of companies that do the same type of product. So you must differentiate yourself by either your service or by how quickly you can get the deal done. Is it both? Is it one or the other?
Actually, it's both. In addition to that, we're very aggressive. Typically, we're top 5 when it comes to pricing.
Great.
In my personal opinion, I think we're number 1 in service. I know there are companies out there that'll do things a little bit faster than us, but we're a boutique concierge level wholesale mortgage company, and ultimately we provide this, top-notch service to our clients, also backed by very aggressive pricing.
Okay, when you say boutique, I think a lot of the audience hears that and thinks, a perfume shop or something like that, which is a very select group. Describe what that means for the audience so that they understand what you and I understand when you say that.
We take pride in looking at the whole scenario and offering the client the best option possible. Sometimes people come to us wanting, like we were talking about dental work. They might come to us and they say, hey, we want to get a cleaning. We tell them, look, we might need, you need a root canal. You know what I mean? So, not saying that we're small. We're a very large company, huge wholesale outfit, but we offer the one-on-one personal service. Ultimately, some of my brokers think that we offer too much service because there's so many hands on deck. Sometimes we bombard them with so much service. They're like, "Whoa, we've never had this. Never experienced this before. I love it. Keep it going."
Well, okay. So when it comes direct to the customers, how do you think that kind of service impacts the customer? Because I think a lot of people who get loans don't see the behind the scenes work that's being done on their behalf.
I completely agree with you. A lot of times we go unnoticed, but from the from the user-friendly electronic portal that we offer to our consumers, it's very quick and easy for them to access their disclosures, look at their type of loan, look at the fees, all that kind of stuff. It's very user-friendly, and basically that's pretty much it. And not to mention, like I said earlier, just the level of service. If they have any questions, we have delegated people that will be able to, help them answer any questions they might have, give them more details on anything that they're signing, anything that they're reviewing, things of that nature.
You know, you mentioned technology and you mentioned the customer portal, which I think really aids in terms of the speed by which you can get things done because the customer has access. They're not in the dark. They can upload documents or fill out forms online. A couple of companies come to mind when it comes to technology, United Wholesale, of course, as well as Rocket Pro. Both of those companies going public. There's always a question of choice in the marketplace and where a customer goes and where a particular loan officer will take their loans. What is 11 Mortgage doing in terms of both improving their technology and also maintaining the broadest choice possible for the customer base?
We're always looking to innovate and improve the level of service that we provide to our consumers and our broker partners. That's something that's technology is kind of a tough cookie to crack because it's ever evolving. Today,
Yep.
What's brand new is outdated in 2 weeks. So we're just always on the forefront of trying to evolve that, tweak it, make it as simple as possible. Because, at the end of the day, time is money. And in the market that we're in, we need to get things done quickly and efficiently because, like you were saying earlier, it's almost impossible to get into purchase contracts nowadays.
Right.
And the COVID epidemic that everyone's facing and dealing with, a lot of people are in in tight spots. They need to cash out. They have things they need to do. So time is of the essence, and we completely understand that and strive to offer the most efficient and effective manner of closing transactions as possible.
Oh, excellent. Now, there's something called overlays, right? You and I know what that is. The customers have an inkling of it when they get their closing estimate. What are the overlays on some of the products? How do you look at whether it's FICO score or down payment or some other things that may add to the cost of the loan?
Typically, previously, before COVID, we were much more aggressive when it comes to FICO scores for our government products. We went down to 580.
Yep.
And because of the COVID, we had to kind of tighten up our requirements a little bit. We're only allowing down to 620 at the time being. Currently, most of those COVID restrictions will be done at the end of this month.
Great.
But for your self-employed borrowers, you need 3 months business bank statements showing that you're still operating and still generating revenue. You need a profit and loss year-to-date, or you need an audited P&L from your CPA. So it's either one or the other. Audited P&L from your CPA or a P&L borrower prepared and 3 months business bank statement. So those are pretty much our only overlays that we have. We're strictly agency. Whatever DU, desktop underwriter, which is an electronic underwriting system, whatever they say, whatever they spit out, that's what we're asking for.
Excellent. And you guys have been around for how long?
We've been around for 18 years.
Okay, so a long time. The source of funds, the availability of selling to agency, do you see any changes that might occur? I mean, we have a lot of talk about rising interest rates and maybe continued tightening on products. I know underwriting standards have been harder than they were even a year or 2 years ago just because of COVID. What do you see coming forward in the marketplace?
Well, everything is pretty much generally underwritten off of a DU, desktop underwriter.
Right.
That is controlled specifically by the major investors, Fannie and Freddie, or Fannie is DU, LP is Freddie Mac.
Yep.
But they have tightened up or reduced their risk assessments. So before COVID, the risk threshold was lower. Now it's higher. So you're seeing the lower FICO score borrowers with higher debt-to-income ratios getting refer ineligible based on risk factors. And you're going to have to go with more of a government product, which is a little bit more lenient towards that. So you've seen them just tighten up their risk threshold to where, let's say 8 months, 10 months ago, a client would have qualified. Now they won't qualify.
Right.
So it's not something that we do, but that's what the agencies have been doing. In addition to that, they also they implemented the adverse market fee earlier this year for refinances, which is another half point, which made the cost of refinancing a little bit higher. And they're starting to wind things down on the investment and second homes. They're charging higher loan-level pricing adjusters, so they basically give less of an incentive for you to do that because at the end of the day, when the market turns, the first things that people usually let go of is their investments or second home. They're not going to usually lose their primary if they have an investment or a second home.
Hey, you know what, Ryan? You're very knowledgeable. I want to have you back on the show again. I really appreciate not only the perspective, but also the knowledge about the marketplace as well as products with 11 Mortgage. Thanks very much for coming on.
Anytime, Jeff. Thanks so much for having me.
Thank you very much. That's Ryan Bagan from 11 Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week, we bring to you guests that give you answers. I don't have all the answers. I mean, I have some of them. I've been in the business quite a long time. But most of the people we bring on the show are from lenders and people in the business who have been in for a long, long time. They have solutions. They can give you solutions to refis, purchases, maybe give you some optimism as to how to get into that house that you're trying to get into, that you're competing with 5 or 6 other buyers on a particular purchase, or you're just looking to lower your payment, rate and term type of refinance. You can hear this show. We're on 5 radio stations in 3 different states, from Albuquerque, New Mexico, all the way up to Las Vegas, Nevada. We're certainly up in the Tahoe area as well as the Inland Empire in Southern California. We're on 10 different podcasts. Daryl, you got that list for us again?
I sure do, Jeff, and excuse me for breaking stuff. It's podclips.io, YouTube, it's radio.com, iHeartMedia, Stitcher, Spreaker, Spotify, Google Music Play, and Apple Podcast.
Excellent. If you go to Apple Podcast or you go to any of these things, say that you like the show. Why? Because it gets us to more people. This information is not easily available, and you have to do a ton of research, whereby for an hour you can just sit here and listen to a bunch of great people who have terrific information. Okay, enough of the commercial. Let's get right to it. Chris Calderon from Lone Stream is on the program now. He hasn't been on before, but I really appreciate him doing this. Experienced guy, and he's got some solutions. And Chris, how are you?
Good afternoon, guys. How you doing?
I'm great, thank you. Okay, Lone Stream. Now, you guys have gotten big, really big. How are you handling the size in terms of personalized service? What do you guys offer that perhaps maybe we haven't seen from other companies? And give us a brief overview of what Lone Stream can help with.
Kind of some of the ways that, in speaking for myself, how I handle the volume, I got a dedicated team that's worked with me for a few years. Mm-hmm. So just kind of having that familiarity with the group, whether it be the underwriters, the account managers, doc drawers, so you can kind of, set some timelines and be able to keep them, again, because it's people that people that you've worked for a long time. Right now with rates being as low as they are and housing market being the frenzy that it is,
yep. That's
kind of something that people need right now, especially, brokers out there, loan officers. They need someone that, hey, we can give deadlines and pretty much keep them.
That's... You are preaching to the choir here. I know that as a loan officer and somebody who also is a real estate agent, been in many transactions where these things are promised, and what happens is you're begging people for extensions because you can't meet the obligation that you've promised them because you got promised to us before. How are you able to, I guess, maintain your timelines? Is it just the fact that you guys are good at what you do, or is there a special process because of technology that's helping you?
I kind of, I'm not trying to plug in and out, but I try to use the in-out strategy. Double, cheeseburger, hamburger, right? And when you do 3 things and you do them really, really well, and I'm not necessarily saying you limit yourself to 3 things, but you do a handful of things and you just start to do them really, really well over and over. Sometimes, and again, this is my personal opinion, sometimes you'll see a lender and they're doing 10 different types of loan products,
right.
And they do them, they just don't do any of them well.
That's a great analogy, by the way. So let's get right to it. Products. Give us an overview of some of the products that you mentioned, and let's see if we can help somebody.
So here's what we do. So we do FHA, conventional VA. We also do some non-QM. With our FHA, we go down to a 580 FICO. Now, there's a new product that, it's so funny that we're doing this today. There's a new product product that we're coming out with, I want to say maybe by the end of this week, and it's a FHA loan, 100% financing.
Wow.
So we'll do a first and a second. And I'm not talking about a second where it's some, city grant or county grant. It's a second. There are no income max. So, for instance, whether your borrower makes, $40,000 or $400,000, this could be a loan that they qualify for. There aren't really any overlays besides the fact that we'll only do SFRs, condos, and duplexes. Unfortunately, we won't do 3 to 4 units. We're going to underwrite that directly to the AUS. So for anybody listening, that's the automated underwriting system, and that just kind of, judges the borrower's, credit, income, assets, etc. That's a product we're coming out with. Since we don't have any overlays on any of our products for our government, it just kind of expands the pool of borrowers. On our conventional, same thing. We don't have any overlays. So as long as whatever the DU asks for or the AUS, that's what we'll underwrite to. Same thing for Freddie Mac. So, right now, every lender has to underwrite within a box. I just tend to think that we have a bigger box.
That's very interesting. So this FHA product, you are selling to Ginnie Mae? Are you portfolioing it? Oh, you are. So this is a product that...
Portfolioing it, right? And like I said, it's a second that we're doing.
Right.
It's not a forgivable second. So, should the borrower ever refinance or sell the property, the second would be due. Obviously, there's a payment on the first and second.
Sure. But
I think it'll give some borrowers a little bit more buying power right now. Obviously, as we've seen prices kind of, jump up a little bit due to the lack of supply, it will give some borrowers a little bit more buying power.
Oh, I love the product. I already want to call like all my loan officers and tell them this is a terrific product out there. Again, more buying power. So if you're in a bidding war, and you have this in your pocket, knowing that you're not cash strapped for the down payment, even at 3.5%, that's a big advantage.
Correct. It's a big advantage, and not only that, I think better than anybody. Sometimes when you buy a house and you have a borrower, and maybe they're putting in, he or she's putting in that last cent. Well, what if the water heater breaks? What if something breaks? It's always good to have a little bit of extra cash, in your back pocket, or maybe they could use this grant. Right, use this second and maybe pay off some debt instead, and it helps out their debt ratio.
Now, does this particular loan go down to 580, or do you have a higher credit score requirement for it?
It will go down to 580, but obviously, once you go below 620, at that point, you might be possibly looking at a manual underwrite.
Right.
And then thus your debt-to-income ratio might be a little bit lower.
Interesting. Debt-to-income ratios, the new way that they're going to start looking at loans, I think it's July, is going to circumvent the debt-to-income ratio because of the non-QM patch. They're trying to figure out a way by which to do loans without, having that in by way of how they're underwriting the file. So are you all prepared to do that soon, or are you even aware of it? Some of the AEs are, some aren't.
We're aware of it, no different than the IRLA, the new 1003.
Yep.
The powers that be, unfortunately, they're going to last second, because I don't even think they've got it, finalized.
Right.
So, unfortunately, sometimes in the lending industry, it's just kind of touch and go.
Yeah, I think so, too. I think they'll postpone it, but it's coming, and I think that having that ability with loans like this makes even more borrowers available out there. Housing market, how are you guys looking at the housing market currently?
If you ask 10 different people in the housing market, you're going to get 10 different answers. Really just kind of how I'm kind of looking at it right now, and I've been doing this since it was 19 years, May 2nd, that I've been doing this. So obviously I was around when the market crashed.
Right.
The way I look at it right now is I think this is just more of a supply issue, not anything of exotic loans like we saw,
I agree.
15 years ago.
Yeah, I agree.
I really think that we'll start to see housing prices maybe cool a little bit, maybe towards the back end of the year, depending on what interest rates do. But I think interest rates, since they're still low, it's just really, really a good opportunity to purchase or refinance if you haven't already done so. Yeah,
I agree. I just wish there was more product, because that would obviously keep prices down. We see, and I don't know how long we can sustain 11, 12% price increases on a yearly basis. That's just unsustainable in my opinion.
Correct. I was reading an article in Forbes on Sunday, and they pretty much said the same thing that you did. The writer of this article was that I don't know that he didn't know how sustainable this was.
Right.
But even when the market does cool down, it'll cool down to something that's a little bit more of a normal type of increase. Whereas right now it's just it's a full sprint, and it'll go down to maybe like a nice jog,
Right.
and good pace.
Hey, Chris, thanks very much for coming on the show. Could you shout out a phone number for people if they want to get in touch with you and talk about loans?
Yeah, sure. My telephone number is area code 818-926-7078. Once again, 818-926-7078.
Chris, thanks very much for coming on the show. Really appreciate it. Want to have you back so that you can talk a little bit more about what you're doing over there at Lone Stream. And again, thanks very much.
You got it, fellas. Take care. Have a good Tuesday.
And you too. That's Chris Calderon from Lone Stream. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. We are on a number of radio stations. We're on a ton of podcasts. We're on YouTube. If you go to YouTube to see the show, Jeff Barton, the Mortgage Voice, that's where you can see it. We're also changing the website, themortgagevoice.com, which should be up. It'll be easier to find different segments of the show and what we're trying to do. Information is key to anything we're doing on the show. So we bring people to the show who have that information. I don't have it all. I have some. But the most important thing I really do is I have contacts with people who actually know what they're talking about. And one of those people joining us today is Kim Soash from Homebridge. Kim, how are you?
I'm great. Thanks for having me, Jeff.
And thank you very much for coming on the show. Okay, interesting market. Rates went up. They went back down. Property values really increasing at an unbelievable rate, and there's a lot of people competing out there for purchases. But rates have come back down a little bit. What's happening at Homebridge? How are you guys handling the volatility in the market, and where do you see you competing in the best possible way for people who want to buy a house?
Well, I think that we're staying competitive in a rate way,
Okay.
for the conventional Fannie and Freddie FHA loans. And rates have been so good, it's hard to not be competitive. I mean, rates are very good.
Right.
But Fannie and Freddie have made some changes recently with the preferred stock purchase that they did, and the Treasury and the FHFA have gotten very worried and are limiting the amount of high-risk loans that Fannie and Freddie can do. And we already saw that take place recently with price hikes in the non-owner and second home area, because they don't want lenders to have more than 7% of their portfolio to be non-owner. And so we saw that happen already, and now there are even more high-risk areas of concern in terms of FICOs that are less than 680, debt ratios over 45, loan-to-values that are greater than 80, high balance, cash out, all of those that all day, every day, we were seeing approvals with Fannie and Freddie. All of a sudden, the automated underwriting systems are considering these to be high-risk loans. So that hasn't been good for Fannie Freddie, but it's been very good for the non-QM segment of business, where it's been more liberal. Now the non-owner occupied, where the rate in non-QM might have seemed higher before than what conventional could offer. Now you're happy you can just get it done, and the rate isn't all that high after all. 'Cause
Right.
with all the ads on Fannie Freddie, it's pretty ugly. And then just the other creativity that non-QM offers for borrowers who don't have traditional tax filings, being able to qualify on bank statements, on 1099 only, asset qualifying, or if it's a non-owner property, just treating it, like a business and qualify on the rental income only. And one of the things that we did was list the DSCR qualification. It used to be that your debt service ratio calculation had to be at least equal to, so your rent had to be at least equal to your, mortgage payment and tax
Right.
and insurance and all of that. Now there's not a minimum, so it can be less. You can be actually, negative on that.
You can be
So,
upside down or negative, as you said, and still qualify for the loan. I guess you have to prove ability to pay at that point. And then how does that calculation work?
Well, they're going to look at there'll be a pricing hit. There'd be reduced LTV. So this is a risk based type of a product. So whenever the risk starts to get to be top heavy, then they'll scale back on the generosity of the LTV or credit requirements or debt ratios and that sort of thing.
Why do you think, Kim? Let me just interrupt you quickly. Why do you think we're seeing these kind of I guess not scared is not the right word, but an increase in, I guess, Fannie and Freddie's inability to fund these loans. They say there's risk. Does that spook the market? I mean, how does a company like Homebridge think?
I think that Fannie and Freddie and the Treasury and the FHFA are looking at there's a lot of forbearance out there, and everyone won't survive their forbearance. Many will. Many will modify, or they'll get deferment, or they'll just pay it off. Like I have had some clients that have been in deferment and they've had the money the whole time.
Yep.
And when they wanted to refi, they just paid it off. And so it's like, well, if you had the money, how come you didn't just make your payments? So, there's all kinds of borrowers. Everyone's financial situation is different. But the forbearance situation is real, and I think that there's a fear, that some of these won't end well. And so they don't want to have a huge inventory of non-owner second homes. They're trying to limit the inventory of potential, foreclosures, I think. That's my swag, my scientific wild.
No, I like that. Are they still accepting forbearance loans into the forbearance program? Like if I came up with...
It depends on what you're doing. So Fannie's very kind of generous. If you've been in forbearance, but you pay it off, and so if you pull your payoff demand, and it doesn't have any missing, deferred, late payments showing. It just shows that, what's due is what's current. They're good. They don't even want a whole pile of paperwork. Simple access, the non-QM, they're like, as long as you're out of forbearance and have made 3 payments, then they're good. And they're even, I would say that, the guidelines for them are more of, they're like the lines in a coloring book. You can still color outside the line and have a picture. So they have guidelines, but you can go outside the guidelines quite a bit with the non-QM program. But then you have FHA, and if you've missed a payment, they don't want to see it. They don't want it at all. So the forbearance loans are out there for sure, but everyone's tolerance for working with that borrower is a little bit different.
I see. Okay. Tell us a little bit about some of the other programs that you're doing. You mentioned non-QM. What are you doing in that area?
Well, non-QM is the simple access product that I was talking about. So it'll do, like, say you have a borrower who wants 1-year tax returns, has to do 1-year tax returns, and you're just not getting that finding with Fannie and Freddie, especially with them tightening up their underwriting criteria.
Right.
So you can do this with 1-year tax returns, because that's how I want to do it. You can do it with 12 or 24 month bank statements. You could do asset qualifying. Maybe it's a trust fund baby, or they've got tons of retirement money and they just want to do something qualifying on their assets only. And then most recently they just added 1099, so you can have borrowers that are maybe in the movie industry, so maybe they're 1099 and W-2 because different jobs pay them different ways, or maybe they're self-employed and they just start 1099. We can do that. And then the investor cash flow product is really DSCR, so that's the one I was talking about, that you qualify on the rental income only.
Right.
And so that's debt servicing, and that one's pretty no doc really, because it's just you just qualify the subject property. So if you own a whole bunch of properties, it doesn't matter. You only qualify that subject property, and you qualify it on its income. And the only thing you have to worry about with all your other properties is having meeting a reserve requirement. But other than that, you don't need all the leases, all the tax returns, all the this and that. It's pretty low doc.
Okay, no, you mentioned so many things in there that would help somebody, especially. No, I like that, because we talk about second homes, or we talk about investment properties with Fannie and Freddie having a lot more overlays. If you really compare those products to these products, i.e. in the non-QM world, you're probably even going to get a lower rate because there aren't the hits, because that's the kind of product they like.
Well, that's what I was trying
Right.
to say prior, was that where it was so easy before to refi your non-owner home or your second home.
Yeah, exactly.
It is home. I do want to say that. Now you could be, depending on, depending on your credit score, the loan to value, your situation, you could be looking at, upwards of 3 or 4 or 5 points.
Right.
In basis points of an add to fee for that rate. So now, for one, and they may not do it. Before you could maybe take your debt ratio up to 50%. Now we're seeing that it's just not approving over 45%.
Right.
So the simple access will go to 50%, and even higher on exception. So it'll do 620 credit scores. It goes up to 2.5 million. So this could be a real rescue product also for something
Right.
that's falling out of jumbo, falling out of high balance. You really needed to do this. You want to pull cash out of a non-owner, and now it's just too expensive to do it conventional.
Hey, Kim, thanks very much for coming on the show. We're up against it. Could you shout out your phone number for those who would like to call you directly to talk about some of these loans?
Oh, of course. It's 818-970-4016. And I really appreciate you having me on the show, Jeff.
Always love having you on, Kim. You're always a bright light and also full of information that can help people get a loan. Thanks very much for doing it.
You're welcome. Thanks.
Thank you very much. That's Kim Soash from Homebridge. This is Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show and listening each and every week. We love you to do that. If you go to the mortgagevoice.com, you go to malibufunding.net, you go to any of these places where you see us, say that you like us. Join up. You want to be a member. These things will help not only you get updated information on a weekly, but it'll help other people find out who we are and where we are. We're in 13 different states as Malibu Funding, the company that sponsors this show. I work for that company. I'm Jeff Barton. And anytime we can help other people, that's the nature of what we do with the show and what we're trying to do by sharing the information. We bring to the show each and every week 3-4 different people in the industry, and this week has been no exception. So we do appreciate it. We are on 5 radio stations in 3 different states. We are on 10 different podcasts. Daryl, you got that 10 different podcasts for us?
I sure do, Jeff.
Great.
It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Podclips.io, they have a lot of great financial information, plus a number of lifestyle and other things. So if you go there, like I say, click on that you like our show so that you can get updates on a weekly as to what we're doing and how we're doing it. Okay. What's happening in the real estate market and how is it going to affect you, especially if you're out there trying to buy something right now? You all know the real estate market is on fire, i.e. there is very little out there in terms of properties to buy. Every seller loves this because they can kind of demand how it goes. If you're an agent out there, you don't like it because dealing with several offers at a time is not only tricky, but there's an inherent bias towards a certain type of borrower, right? Obviously, somebody with cash, they're a good borrower. As long as they can prove they have the cash, they don't have to worry about getting a loan. You can remove contingencies right away. But I have an article that I wanted to share with everybody about some of the problems inherent in this type of market and maybe some of the solutions out there. I think trying to find a solution to this particular market, we talked about it last week too. Finding your ability to get to the seller the best possible portrait of you as a financial option in choosing between several buyers for their property. So let's get right into it. one of the questions that's asked in this particular article is, how are buyers coping in the highly competitive housing market? How are they coping? So this is more to the psychological benefit of those, or detriment of those people who are trying to buy out there. They're not coping well, okay? And if you're a buyer out there, you know exactly what I mean. In a normal market, you sit down, you figure out what you can afford, and you go about finding the properties that you can afford, and you choose one, or you go back to renting. Pretty straightforward, right? In this particular market, the trouble is, you can see something in the market that is, you know, for a certain price, $200,000. Well, nothing in this market is $200,000, but let's say it's $200,000. That means you look to properties up to $225,000 down to $175,000. So you have a block of $50,000 range, and you'll go to a particular neighborhood that you like, and you'll see 3 or 4 properties, and you go in and you look at them all. In this market, if you do that, which I guess you can, depending on the price range, the problem is that you're going to be competing with 4 or 5 other people. So that price range that you're really looking at is probably going to be 10, 20, maybe even more percentage-wise above what you really can afford to pay. That's frustrating for a buyer. You are totally set and ready to buy at a certain price. You got the FICO score, you have the money down, and you've got your job that you've been at for years. You're ready to buy. But there is such a shift, a shifting sands mentality, because you don't know exactly what the price is going to be at the end. And then when you can't afford whatever price it does end up, who are you competing with, and what exactly do you have to do in order to get the property? That is frustrating. Matter of fact, in this same article, let me just get it. Okay. This same article says 1 in 3 buyers who did not make an offer did not want to compete with other buyers. And if you fall into that category, I totally understand it. I hate competing for something that I think should just be readily available. Like, beginning of pandemic, when the toilet paper craze was around. I'm sure everybody remembers that, right? That was not that long ago, when you had to go and compete with, you know, some idiot who bought 10,000 rolls of toilet paper the first 10 minutes of the pandemic, and he caused everybody else a panic. My wife went to the supermarket and encountered a person who was crying because she couldn't find toilet paper for her and her family. So my wife went home, and we had some extra, and we gave them to her. This is how crazy the market is when you have panic buying. Well, it's like that in real estate right now. And so if you're one of those people who just don't want to compete anymore, I 100% get it. The psychology behind not wanting to compete is just, you don't want to get into that situation where you're forced to pay more than you want to, or do something that you don't want to do. That's that, what is it, auction mentality, right? Have you ever been to an auction? I've been to some, and sometimes you just can't help yourself by putting your hand up, especially if you want something. House auctions are like that, on the courthouse steps. Other kinds of auctions are like that as well. The intense competition usually brings out about 5 offers per home. So you're competing against these 5 other people who are in the same position, the same crazy makeup in their head. And you know, when you want something, you automatically do more than you would have done if you had a choice whether to walk away. And that's the key in any house buying negotiation. You have to have the ability to walk away from the deal. Have to have it. If you need that property more than anything else, you are just giving in to whatever the seller wants. And if you are in that position, I totally understand the psychology behind it. I don't like it, and I understand if you walk away and don't want to do it. Another thing that I touched upon earlier, is that the rising number of cash buyers. Now you might say, well, how the heck can there be cash buyers during a pandemic? Well, you'd be surprised. Now let's say that, I don't know, what percentage of number of people are out there right now thinking, well, if I can't get a loan, I'll just buy cash. Well, according to this article, when you're competing against people, and 23% are the share of cash buyers in this market. So if you combine the 5 offers for each property that I just mentioned, and 23% of all buyers are cash buyer, that means 1 out of 5 of those buyers is offering cash. So psychologically, you know going into any offer that you're competing against the cash offer person. Because if there's 5 per and 23% of those people buy cash, well, guess what? One of the buyers in your group of 5 that are competing for the house you want, they're going to be all cash. How do you compete with that? That's depressing, obviously, because you want that house and you're competing with someone who's all cash. Now, there are other things within an offer that you can do in order to make your offer more attractive. There's contingency period, there's quick close, there's offering more money. I don't know what the cash buyer is offering, but are they going to be willing to pay more than they are if they're coming in all cash? Because they know there's some statistics as well. So all of these things in the psychological market say that yes, it is it's very difficult on a buyer. And I totally understand it. And I totally get what's happening if you're one of those people out there and you're thinking, hey, how can I compete? Well, we had suggestions last week on the show. We had a guy from down in New Mexico, and he talked about it. He's one of the agents on the show. Anyway, we are up against the clock. I really appreciate the discussion, as always, and my name is Jeff Barton. Tune in each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.